Welcome to The Explainer. Today, we are diving into a fundamental rewiring of the financial markets. Seriously, if you're still looking at everything through the old lens of just earnings and economics, you're missing the main event. The entire rulebook has changed, and we're about to walk you through exactly how.
And really, it all boils down to this one idea. This quote nails the new reality we're all living in. It's not just about how well a company is doing anymore. It's about the political sandbox that company has to play in. Everything, and I mean everything, from tariff schedules to geopolitical summits, is now drawing the lines on the chart for your portfolio.
So, let's just put it side by side to make it crystal clear. The old way of thinking, that markets were all about earnings reports and economic fundamentals, that's basically a history lesson now. The new reality, it's driven by policy deadlines, who has power on the world stage, and what governments decide to do. And this shift, it completely changes where you find risk and where you find opportunity.
Okay, so what does this new rulebook actually look like when the rubber meets the road? Let's break down how this rewiring is playing out, because there's one common thread that connects everything from stocks to crypto to oil.
And here it is. The common driver is state action. It's that simple. That means the most important clues you're looking for aren't buried in a company's quarterly report anymore. Nope. They're in the fine print of a trade agreement or in the national security memos of a global power. That's what's moving the needle now.
To really see these new rules in action, we're going to look at two perfect case studies, the US-EU transatlantic deal and the really high-stakes situation between the US and China. They're great examples because they show two very different ways power is being used right now.
First up, let's talk about the deal with Europe. At the very heart of it is this number, 15%. That's the new tariff ceiling the US put on most goods coming from the EU. But, and this is key, don't mistake this for a normal trade deal. The source material calls it a risk containment device. Basically, it's a strategic move by Washington to control the terms and manage its own geopolitical risk.
And when you start to peel back the layers, you see just how one-sided this is. Sure, the EU got to dodge a massive bullet on cars, but they accepted a way higher base tariff on everything else. Plus, those heavy duties on metals, they're still there. In exchange, Europe made these huge promises to buy US energy and invest in the US. But get this, those pledges are non-binding. The real kicker is that all the power, the optionality, the ability to flip the tariff switch on or off, that sits entirely with Washington.
Now, let's pivot to China, because this is where the strategy gets even more aggressive. We're not talking about containing risk anymore. We're talking about pure control. A potential 100% tariff on Chinese chips isn't designed to raise money. It's what the source calls a control tool, and its goal is to fundamentally reroute and secure the global tech supply chain. This is a much, much harder line.
And this all could come to a head on August 12th. The potential outcomes here are just all over the map. We could see another short delay, which, markets would probably like, or you could get a snapback where tariffs just explode, causing immediate chaos for supply chains. The third path is this long glide path, which just means the uncertainty gets dragged out. The point is, the difference between these scenarios is massive.
And this isn't just about formal trade deals. We're seeing broader geopolitical stories create huge winners and losers, sometimes overnight, all based on a single headline. I mean, just look at this chart from a single week. You've got tech stocks rallying pretty nicely, while crude oil absolutely cratered, down over 5%. These things are moving in totally opposite directions. So what gives? What's the hidden story that could possibly push tech up and oil down at the exact same time?
The answer is a single geopolitical narrative. That sharp sell-off in oil, it wasn't about weak demand or a slowing economy. Nope, it was about the market suddenly betting on a higher chance of a peace deal in Ukraine. Just the possibility of Russian oil coming back online was enough to send prices tumbling, and it totally overshadowed everything else.
This is the new dynamic right here, in action. The market is weighing probabilities. In this case, it decided that potential peace in Ukraine was a bigger deal than ongoing risk in the Middle East. This creates what analysts call dispersion. Basically, one political headline acts like a binary switch, yes or no, sending different assets flying in opposite directions. All of a sudden,
Your specific exposure to one story is what matters most.
So with all these political winds blowing the economy every which way, where does that leave the Federal Reserve? You know, the one institution that's supposed to keep things on an even keel. Well, it leaves them completely and utterly trapped.
They are caught in what's being called a stagflation trap. Think about it. On one hand, new tariffs push prices up. That's inflation. But on the other hand, the uncertainty from those same tariffs makes businesses and consumers nervous, so they stop spending. That slows growth down. The Fed's usual tools, they're just not designed to fix both of those problems at once.
So this creates a totally impossible choice, right? Does the Fed cut interest rates to help out the slowing economy, even if it's like throwing gasoline on the fire of inflation? Or does it keep rates high to fight that inflation and risk pushing the economy into a deep recession? There's really no good answer.
And this is exactly why every little piece of economic data is now under a microscope. A hot inflation report could absolutely crush the tech rally, which has been fueled by hopes for rate cuts, but a cool report would just pour more fuel on that fire. Even good news can be bad news. Strong retail sales sounds great, but it just gives the Fed an excuse to wait longer to make those cuts the market is desperate for.
What's really fascinating right now is that the bond market is priced for perfection. It's basically believing two contradictory things at once: that the economy will be just fine and that the Fed is going to cut rates anyway. It's this perfect soft landing scenario, but it is incredibly fragile. It could be shattered by one policy decision, one geopolitical shock, which leaves us with one last big question to think about. For decades, investors were trained to analyze economic risk. But in this new world, in a market that has been completely rewired by governments and politics, is the biggest risk to your portfolio no longer a recession, but an election, a summit, or a single tariff announcement?